Welcome to Industry Episode 6, a review. So in Episode 6, tons of stuff goes on, and there's massive amounts of drama involving Christmas parties, alcohol, drugs, sex, you name it, it's in there. There's less on the technical side, so this is going to be a much shorter one than normal, but there are a few things to talk about. So let's get started.
You eat sandwiches all year. Now I show you how they taste.
I thought this happened in January.
It does for other people.
So why are you giving it to me now?
Because I want to. Because I can. Because you deserve it.
Why do I deserve it?
You can't look at a number like that on paper with your name next to it and still doubt yourself. That's not logical. You're allowed to thank me.
So here they're talking about Harper's compensation, or in fact, Eric is giving Harper her year-end comp. Now that would normally happen in January. It does tend to happen in different times in different banks, but in this case it's happening before Christmas. And from looking at that bit of paper, you can see that the bonus compensation was about 50k, and the total compensation was about £116,000, which suggests that Harper is on 66k basic, and then she gets a 50k bonus. Now, I think the basic is a little too high. Certainly my understanding of the current market in London for graduate hires to the investment banks, your base salary should be about 50k. So it would be unusual that she'd be on 66. So I think that's a little on the high end. And again, the bonus is probably a little bit too high. I think looking at the research, you'll see that most first-time analysts can expect a base of 50k and then a bonus between 20 and 40k, and that will depend on your performance. So if you're a high performer, you'll be at the top end. If you're a low performer, you'll be at the bottom end or have nothing. And you'll tend to see that there's only a very few people at the top end. So Harper's total comp of 116k in year one is actually very, very good indeed. Probably too high in comparison to what you'd actually expect currently in the UK market, certainly for the base salary. I think with the bonus you could potentially get that if you had stellar performance, and certainly Harper has done pretty well. So the other aspect is at the end of the conversation, Eric goes, "You can thank me for this." Now, culturally in investment banking, traditionally, people have been really kind of aggressive about compensation, and they would never thank you. They would never let you know that they're pleased, and they would always say, well, I was kind of expecting more, even if it was actually a very good bonus. And that's a bit of a cultural thing. It's not a very good thing in my view, but it is a bit of a cultural thing. But nevertheless, in this case, Harper should be very, very happy based on what you'd normally expect within the financial markets in your first year.
Why?
I need her on the desk. Clients asked about the Fed. I made trade any surprise, and she's gonna book it.
I don't want her doing that.
Well, she already agreed to it.
Is this true?
Now here they're talking about the Federal Reserve, or as it's shortened in the program, the Fed. And the Federal Reserve is the central bank of the United States. And the central bank sets interest rates. And it does that at the short end of the yield curve through something called the Fed funds rate. In recent years, it's tried to control the longer term or longer maturity of interest rates, in fact, the 10-year rate, using something called quantitative easing. And we're not going to discuss that now, but generally speaking, what happens is, under normal circumstances at least, the Federal Reserve sets rates by changing the very, very short-term interest rate, which is known as the Fed funds rate. Now, the market will have an expectation about the Fed and whether they will increase rates, which is known as tightening, or decrease rates, known as easing. And they will position themselves, position their portfolios, the investment managers, according to whether they think that the Fed is going to increase or decrease rates. So if there is a surprise, which means the Fed doesn't react as you would expect it, markets will move really significantly and very quickly. So everybody's trying to figure out what they think the Federal Reserve is going to do with interest rates. And that's what they're talking about, the kind of Fed trade surprise.
Having the night off?
Have you got anything on dollar positioning pre-Fed?
You've come here to ask me a work-related question?
Now, this is a bit of a follow-on from the Federal Reserve interest rates. The Federal Reserve sets interest rates, but that has other effects on economic numbers. A really important effect of interest rates in any country is that if you increase interest rates, what it does, it gives fixed income investors a higher return on their money. So what you'll see is a lot of money being attracted into that market. And if a lot of money goes into the market, they'll have to buy the currency to make the investment, which means the currency will appreciate. So normally we'd expect if the Federal Reserve increases interest rates, we would normally expect the dollar to strengthen, go up in value relative to other currencies. So ideally, if you're a fund manager, you want to position yourselves in both your perspective of interest rates and your currency with a kind of good position based on what you think the Federal Reserve is going to do. So if you think the Federal Reserve is going to increase rates and you don't think that's priced in by the market, then what you will want to do is you want to make sure that you have more exposure to the dollar, because if the Fed does increase rates and it's not expected by the market, there'll be a sudden increase or jump in the value of the dollar relative to other currencies. So obviously you want to be holding the dollar if it goes up in value. Now, the other thing they mention here is IB messaging. And I think what they mean here is the Bloomberg messaging. Bloomberg has a messaging service that traditionally has been heavily used by the traders and salespeople. In recent years, a few of the banks have tried to come together and create a new system. There's one called Symphony. But generally, I think when they're talking about IB here, IB messaging, it's the Bloomberg messaging, instant messaging in Bloomberg.
People like to dress up this sell-side, buy-side shit, you know? Yeah? But let me remind you, you're in the service industry, my friend.
Now, buy-side and sell-side are really heavily used terms. And I'm going to describe it in two ways. Firstly, in the financial markets, in other words, the trading floor and the fund management industry. In that context, the buy side is the fund management industry. In other words, they are typically buying securities for their portfolio. They, of course, will be selling them, but traditionally that's known as the buy side. The sell side is the investment bank's trading floor, which are servicing those fund management clients. In other words, they are executing trades on their behalf. They're giving them ideas. Essentially, they're servicing them as clients. Now, often people see the sell side as kind of hard work because you're constantly selling, you're constantly servicing your clients, whereas the buy side is a bit less stressful because you're not having that constant selling pressure. Of course, you have a different pressure in the buy side in that you have to get good returns, otherwise investors will withdraw their money. So it's a different level of stress. Now, within the IBD area or investment banking, the sell side again would be the investment banking department or division and the advisory that the investment bank is giving corporates and private equity firms. The buy side in that context would be working for example, a private equity firm who is investing money, buying companies. They'll also be selling them to as well, or on the corporate side too. So essentially the sell side is the investment bank, everybody else is the buy side. But it's a very important terminology that people will talk about in the industry.
Hey, sorry, I was just getting a drink.
That's a very strange way of saying you're pleased to see me.
I didn't know you were coming.
What? Of course I'm coming. You are my coverage. You girls are my coverage. Look at you two. Look at you two. Mwah. This booze, by the way, is a leading recession indicator. It's disgusting.
In this clip, they're talking about coverage. And what they mean by coverage is essentially helping, it's almost like a sales description, because within a bank, you normally have product teams and you'll have coverage teams. A product team will be very specialized in a particular financial product, whereas the coverage team will typically look after a range of clients. And the coverage team can either be described as a kind of overall product umbrella like equities, but more commonly it's geographically focused. So for example, you can have teams which will be UK and Benelux coverage. So they will cover clients within that region. And that split between product teams and coverage teams works on the trading floor, but also within the investment banking division as well. There you'll have execution teams like M&A, which are kind of specialist product teams, and leverage finance. And then you'll have coverage teams, which will cover, for example, Southern Europe. So this term coverage is essentially giving clients access to all the services that the investment bank can provide and being like a one-stop shop. Now, they also mentioned here the leading recession indicator. They're talking about the poor quality of the booze, or in this case, the fund manager is saying that the poorer quality the booze, the more likely there is to be a recession. But what I want to talk about is this idea of a leading indicator. So there are lots of economic indicators, the inflation rate, GDP growth, and those tend to be, or certainly GDP growth tends to be a lagging indicator. But there's some indicators that kind of give you an early warning system of what's happening in the economy. And that is what she's describing here. She's saying that if you see poor quality booze in the investment banks, that's an early indicator that there's going to be a recession. So you tend to have leading indicators and lagging indicators within the economic sphere.
So?
Fed left rates unchanged. I'm just waiting to see if there's anything material in the language.
Now, we eventually get the end story of what happens to interest rates, or what the Federal Reserve is doing to interest rates, and they leave them unchanged. Now, that could still move the market if the market wasn't expecting it. So if the market was expecting rates to rise and they were left unchanged, that still would move things. Now, the other thing that will happen, the Chairman of the Federal Reserve will make an announcement in relation to the interest rates. And in that announcement, they will talk about the perspective of the market. Sometimes they will give some indication about future easing or tightening. Easing is where they lower interest rates, tightening is where they're raising interest rates. And the financial markets will pick over those pronouncements literally in minute detail, picking up little glimmers of what they expect the Federal Reserve to do in the future. Now, as a consequence of that, the Federal Reserve know this, and they will use this as a signaling tool to the markets. So they will signal to the markets whether they think interest rates are on the upward trajectory or a downward trajectory. And often just that signaling alone can mean that aims are achieved. And a good example of that is in the financial crisis. I think the chairman of the ECB, European Central Bank, said, we will do anything to stabilize the euro. And just saying that calmed the markets. So it's a really responsible position being the Federal Reserve chair, because you're in a very, very powerful position, and something that you say can seriously move markets.
Riveting, isn't it? So Nicole was on the turn into a bit of a handful, you know.
Merry Christmas. Did she tell you she was coming?
Nope, just turned up. You know, sometimes I think I did you a disservice introducing you to her. But you can use that relationship on Riff, you know? So it'll all be worth it in the end.
Now, here they're talking about Riff. And right at the beginning of the series, it was never really made clear about whether the new hires into the bank were interns, just there for the summer, or permanent grads. Now, it seems to me pretty clear now that they are permanent grads. And then they're talking about RIF, reduction in force. Now, in my experience, I've never really heard the term RIF, reduction in force, other than the context of a big restructuring. However, it is worth noting that if you join an American-based institution, Goldman, Morgan Stanley, J.P. Morgan, Bank of America, normally you get offered initially a 2-year contract. And at the end of 2 years, you're expected to leave. Now, the reason for that is that certainly in the United States, culturally, people will do a 2-year contract in an investment bank, and then traditionally they will have gone to business school. And then at the end of business school, they can either decide to go back into finance, and often they will join the same bank that they were an analyst at, and they will join as an associate, the next level up, or they can go into private equity, hedge funds, or industry, or set up their own business. Increasingly in recent years, what we're seeing is people joining investment banks and then almost immediately wanting to get a job in private equity or a hedge fund. And often they line up that job literally in the first month or so of joining the investment bank. So in a year's time, they'll leave to a PE firm. And in fact, a stat I heard recently is that the average tenure of a Wall Street analyst is about 1.2 years. In other words, in their first job, they only spend 1.2 years. So you can see how short that is. And that creates a real problem for the investment banks. In Europe, there tends to be less pressure of moving after 2 years. And so as a consequence, often European banks will kind of give you permanent contracts rather than 2-year contracts. Now, even in the American banks, if you've got a 2-year contract, often they will give the high performers the option to extend for another year, do a 3-year option. Certainly Morgan Stanley, they had something called ACP, the Accelerated Career Progression. And they give it just to the really high-performing analysts, that 3rd-year slice. And even after that, in some cases, they will just promote them directly to associate without them going to business school or anything like that. So that route is also open. But traditionally, the American investment banks have had a 2-year contract. The European investment banks have had a permanent contract. But there will be a lot of attrition because it is a bit of a pyramid. You've got a lot of people at the analyst level, less at the associate level, less at the vice president level, less at the MD level, etc. So that is episode 6. Not too much to say in terms of technical content, but masses happened in the drama of the series. All the drugs, the sex, all sorts of shenanigans going on. And I do think it is worth saying that this is definitely dramatized. Although I'm sure a lot of those things have happened in the industry, I don't think they would happen in such a concentrated way that this show portrays. But it makes very, very good TV.